Hi everyone, welcome to Hustle Muscle Invest. If you're new here, I'm a 37-year-old Singaporean, no car, living in an HDB flat and trying to stay disciplined with my investments. My goal is to build a steady income stream from my stocks. Right now I'm focusing mostly on dividend stocks to make that a possibility. I will be looking at growth stocks as well, but the current focus is on dividends. Now, NTT DC REIT is the up-and-coming IPO that will be listing on 16 July in Singapore. This is the brand new REIT that is offering a forecast dividend yield of up to 7.5%. This actually made me drool a little bit. It sounds great, right? But is it actually sustainable? In today's video, I will bring you through what I've been looking at NTT DC REIT and from a standpoint of whether or not I will be wanting to nibble a little bit on a position for NTT DC REIT. Now, let's get into what NTT DC REIT is about. Firstly, NTT DC REIT is backed by NTT Group. NTT Group is Japan's largest telecom company. It's raising US $773 million in what is Singapore's largest REIT IPO in over a decade. At IPO, the REIT will own 6 data centers spread across Singapore, United States, and Austria. The total portfolio value is around US $1.6 billion. This gives you instant exposure to global data infrastructure without having to go overseas to buy these assets individually. However, let's get to what everyone's talking about first, the yield. The projected distribution yield is 7 to 7.5% for the first 9 months and 7.29 to 7.8% for the full year ending March 2026. This makes it one of the highest yielding REITs on the SGX, especially in the data center space. Distributions are SGD denominated. There's no dividend withholding tax for local investors. It's structured as a Singapore REIT, so you get tax transparency. So on the basis of income angle, that ticks a lot of boxes for anyone that is actually comparing it to, dividends that you receive in the US and then having to pay a withholding tax, etc. Of course, it tickled me because of the high projected yield, of course. And also I like the data center space. It powers everything from AI and fintech to cloud and video streaming. Basically, for NTT DC REIT, these are the few pointers that I like about it. Firstly, it's a pure play data center REIT. Second, you're getting exposure to freehold assets in the US and Europe. It's backed by NTT, a sponsor that operates over 190 data centers globally. And then they've also got growth plans in APAC, possibly expanding to Indonesia, Vietnam, and India. As someone who looks for stable, growing income streams, this definitely caught my eye. Now, if we then also take a look at the lease structure and WALE, which is the weighted average lease expiration, this is where it actually gets pretty interesting. Let's slow down a little and then we look at why the lease structure actually matters. We start off with the Singapore asset. The land lease runs until 2070. Okay, this sounds like a long time. Given the fact that right now it's only 2025 to 2070, it's pretty okay for a Singapore-based asset. But the income is based on a lease to NTT Singapore. The weighted average lease expiration, however, is just 0.9 years. Why is that? because the lease is actually renewed annually. Okay, so while the asset is long term, the income stream to me is actually short term, and that's important for yield stability. What about the other five data centers that is not Singapore-based assets? All of them are freehold, and the tenants are mostly Fortune 100 or 500 companies. Here's the weighted average lease expiration breakdown for the California DCs. It's between 2.9 to 8.1 years. It's leased to a Fortune 100 automotive company. And then for Virginia DC, 4.7 years. Software tech firm. Vienna DC, 7 years. It's leased to a Fortune 500 tech firm. So on the overall portfolio weighted average lease expiration, it's about 4.8 years. And the occupancy rate is about 94.3%. In totality, that's quite strong, and it's better than what I've seen in some of the US-based REITs, to be honest. Then let's talk a little bit on valuation, right? The IPO price is at Sing dollar 1.276 because it's priced at USD $1 per unit for the IPO. So I'm just doing a rough calculation on the exchange price here and there. This essentially means that the net asset valuation, the estimated one, is around $1 to $1.05 SGD. So with that, we're just getting some implied price to book ratio range between 1.2 to 1.28 times. I know that's not cheap, but it's not crazy either. Why do I say that? Now, if we compare this to Keppel DC REIT, Keppel DC REIT is trading at a range between 1.5 to 1.8 times price to book. And then for Digital Core REIT, it's obviously lower at 0.8 to 0.9 times, but it also comes with more volatility, right? It's also worth noting that for NTT DC REIT, its gearing is at 34 to 35%. 70% of their debt is either hedged or fixed rate. So it's quite reasonable for you play. Then in that case, if it's so good, what are the key things that's making me a little bit watchful, right? I do think that the first thing that jumps out is still going to be, for me, the short weighted average lease expiration in Singapore. It's only 0.9 years. I know it's renewed annually, and it's also leased to an entity that is from NTT itself, the sponsor. So politically, I don't think they're gonna sort of not want to continue the lease with them. But I'm also not exactly sure is there gonna be a renewal risk eventually, right? So maybe I'm overthinking this, but this remains something that will stand out to you on paper if you just look at it in a different light. So for geographic spread, I think while it's global, it's not yet diversified across Asia. Yes, the concentration starts from, Singapore side as one key foothold that we can use, but expansion into APAC is still a future plan. The valuation of 1.2 times price to book is, yes, it's a premium, but I feel that it's still acceptable. And with REITs, obviously they're all vulnerable to interest rate sensitivity here and there, but I do think that entity has hedged a decent portion of its debt for this, and if it's a rate cut environment, I think it will eventually be even more palatable to NTT moving forward. So, in totality, this isn't a risk-free, high-yield vehicle, but it's also not a junk IPO. And if you ask me for my final thoughts of will I buy it? For NTT DC REIT, it hits what I'm looking for sure. But I will start pretty small because I do like the high forecasted yield, the strong sponsor, exposure to its digital infrastructure, and if you look at the assets outside Singapore, they're mostly freehold assets, and the gearing is pretty reasonable. I will, however, monitor how the Singapore lease structure evolves and whether management delivers on its Asia expansion plans moving forward. So even though if I take up a small position, I won't be adding anytime soon, I'll be watching it over the next few quarters, and whether or not I'll scale up, I'll wait till what I see gets reported. So this is my closing thoughts on NTT DC REIT.
And there you have it. NTT DC REIT, once again, listing on 16th July on the Singapore Stock Exchange. Comment and tag me if you're also going to get it or you're waiting it out for a few quarters. As usual, if you find the content helpful, please like and subscribe, and I'll see you in the next video.